Welcome back to Candlelight, where price is a mechanical function. This is the second part of a two-part video on why waiting is so important and why the vast majority, like the 99% of a trader and investor's job is not doing anything, is waiting to do the right thing at the right time. Now, the first video I went over on what you don't want to be doing. You don't want to be buying after a rally in price, or you don't want to be shorting after a massive drop in price. While it might be tempting, and there's a huge misconception on all markets, stocks, futures, currencies, it doesn't matter, where you want to buy after price shows you strength. That's the last thing you want to be doing. By definition, price falls when it's from a high point. You can't fall when you're already on the ground. So if you buy after price has shown you strength, you're not buying after price has shown you strength. You're buying into weakness, because that's going to be the origin of where falls originate from. And particularly if price moves ballistically to the upside, let's say, that's a pocket of air. And I've made a video about that, explaining why ballistic movement, it doesn't matter what it is, population or price, or let's just say heat, an explosion, a supernova doesn't continue to grow. The acceleration of heat is really intense and really fast, but it dies just as quickly. So when price moves ballistically in a direction, that's unsustainable. 90 degrees is good to give you an area where you want to go in long or short when it re-enters that area. You don't want to be catching that original leg. You don't want to be buying when price is rallying really hard, or shorting when price is falling really hard. So first video I went over what not to do. This video I'm going to be going over what you should be looking for and why waiting pays off huge. I'm going to be going over the exact same three markets. There we go. I got that one. One is a futures market, one's a stock market, and one's a currency market. Because all markets work on supply and demand, it's a mechanical function. So if you can be looking at any chart, any market, any asset, they all work the exact same way. If there's supply and demand, it's a mechanical function. So let's jump right into it. All right, right here I'm going to be going over platinum futures, and I'm going to be focusing on my daily chart, where every candlestick represents 1 day, and my 240-minute chart, which is 4 hours. Every candlestick represents 4 hours. The right one is a 60-minute chart, but for the purposes of beginners trying to learn what technical analysis is and how to reprice, let's just focus on the bigger time frame, because it's a bit slower and just easier to understand. So on the last video, I explained why you don't want to buy after a rallying price, particularly this ballistic movement to the upside, really strong. You're thinking, oh, that's going to continue to go. No, that's where price falls. Now, if you're already in the move down here, if you already bought at the low, then that's fantastic, and that's when you should be, buying low and selling high. Take profit. And if you did get in, this was the beginning of the move. You notice you're already in demand, which is at the low of this rally. And if you did get in, you would have gotten in. Here was your demand zone, and you would have bought right here. But let's just say you didn't catch that. You need to be okay with waiting for price to continue to rally and give you demand zones. Here you have a rally, base, ballistic movement. But at this point, you still want to wait because you're way too high and price is moving ballistically to the upside. Sit down and just wait for price to come back down. At this point, you're now in an uptrend. That's fantastic. In an uptrend, you want to buy low and sell high. So by definition, you want to wait for price to give you demand zones, right? Rally, base, rally, and then come back down into demand. So you have to wait for price to rally to the upside, giving you the origins of strong moves, because that's where demand exists. And then wait some more for price to come back down into those zones. So this whole, or the origin of this leg, for example, right here, is right here. So you need to wait for price to rally away and not click the button to buy, because you'd be buying high. And once you're already high, ballistically high, as a matter of fact, this is good ballistic movement. You want to wait for price to come back down into demand. So you wait, and right here, this leg right here on a daily is this leg on a 240, this whole leg. Within this area on a daily, which would be right here, you can make that even smaller. And I go over that too on multiple time frame analysis. You go from a big zone, and then within this big zone, that's the origin. And notice you have ballistic movement out of that demand zone, nice 90-degree movement. The origin of that move, that's where demand exists. And I bet you anything, when price comes back down into that zone, there's going to be overwhelming demand there. So price is in an uptrend, and if let's just say if at this moment in time you're thinking, oh my goodness, it's really going, that's not where you want to be. That's not where you want to be buying. That's ballistic movement up. Soon, and because that's unsustainable, soon price is going to fall. And neither do you want to be shorting down here, because now you're in the origin of this leg right here. That's where demand is, and you're getting a small bounce. So when price starts to make lower lows, now you're in some kind of a downtrend. And notice, just quick example. Do you notice how here, for example, after this strong ballistic move down, you don't want to be shorting once it's already made that move, because price is going to be bouncing, because by then it's already in demand. And another example, ballistic move to the downside, you don't want to be shorting after it's already made that, because by then you're already in some kind of demand here, or getting pretty close. Right there, you already ballistic movement out, that's demand. You bounce from there. You don't want to do anything after it's already made the move. You want to catch the beginning of it. Another quick example, ballistic movement out. You don't want to go long here, you want to go long right here. In fact, you could have made that even smaller actually. The origin is down here. The origin of that strong move, that's demand. You get a nice bounce there, that's a good 5-to-1 trade. But I'm going to the minutiae. Let's just show you the big picture. So you want to wait for price to come back down into demand, and you just keep on waiting, and then price, sure enough, comes right into your demand zone right here. And notice how you have ballistic movement down 90 degrees. Because price moves so ballistically, which means quickly, it didn't have any time to create supply zones along the way. So the bounce to the upside is going to go all the way back up. There is nothing stopping it. That's a pocket of air. Now, this was a more advanced trade. As a beginner, I do not recommend you take this, simply because it did break that trend line. But ballistic movement like this is unsustainable, which is why you don't want to be shorting after that. You want to be buying it. And this is when you buy low and then you want to sell high, right? So that massive rally, it came, or the rally out of this demand zone is now supposed to break this downtrend. And again, this is a more advanced trade, which is why I don't recommend beginners taking this one. But the beginner trade, or the simpler trade, is going to happen right here. So let's just pretend that we didn't even take this shot. Let's say that we're not even in it, right? Price is rallying. At this point, you don't want to go into it. You don't want to buy anymore, because by now, price is now coming into supply. But because it's in an uptrend, it's going to make higher highs and higher lows. Remember, we're already in a larger time frame uptrend. You might have like a midterm downtrend, but what you want to do right here is wait for price to break that short-term downtrend, give you a demand zone, and then wait for it to come back down. So let's go to our daily, and here you're getting a rally, base rally. At this point, you do not want to buy. It's showing you strength, but it's coming into weakness. And then it really went high. So now at this point, you're really thinking, now this is fantastic. Right here is an excellent demand zone. It fell. It's the rally base ballistic movement out. It also happened to broken this downtrend. That's where you want to be buying. That's where demand exists. So you want to not only wait for you to get ballistic movement upward, which you should be getting if you're in a demand zone, but you also want to wait for price to come back down. So you continue to wait, and don't get enticed by, oh my God, I'm going to miss the move. if it's ballistic movement, that's one, exactly what you want to be seeing for you to go long. And second, it's not going to last. It's just not. It's a pocket of air. There's nothing sustaining it until you come back down into the demand zone, which is the origin of that move. That's where those buy orders exist. And you want to put your buy order right on top of the massive stack that created that large move. Those orders are still in the market. They're still there, which is why price will most likely, your odds are increased right here, bounce to the upside from this location. And within this daily rally-based rally on a 240, this area is right here. It's that whole area. Within that area, multiple time frame analysis, that's really big. You can buy there. You can buy the whole. You can buy right when price hits the high of your zone, and then have your order for exit. In other words, if it breaks below this, you'll go out for a small loss. Love your little losers. I'm going to make a video about that, and that way you're not losing a whole bunch of money. But within this area, we can make it smaller. Here you have a rally base rally, and notice you have a drop and then rally here. It's right there. So instead of risking all that, you make your zone even smaller, and then that's where demand is. Price is going with that, is going along without you. And again, let's pretend that we didn't take the shot, because that was a much more advanced shot. But this is the simple one. This is the easy one. So you wait for price to rally, and then you wait some more for price to come back down. And again, notice how once you're here, let me make this a bit bigger actually. You have 90-degree movement to the upside, that's unsustainable. And then ballistic movement to the downside. So you don't want to be buying after this rally in price. And let's just say you were tempted to short. You're saying, oh my goodness, it's falling now. You don't want to short after it's done that. Guarantee you anything, the origin of this large move up here, that's where price is going to come back up. So you have to wait for price to fall, and then wait for price to go up into the origin where supply exists. So you wait. Let's see if it hits. Yes. That's where supply exists. And then ballistic movement down. You don't want to be shorting after this fall either, because now you're going to be coming into demand. So that's a perfect example of that. And then you wait. Sure enough, right into it. It comes into demand, and that's when you want to, if you're in an uptrend, you want to buy low and then sell high. And all you do to sell high is you put a trend line on this thing. Right here, you have perfect trend line. You have the low right there, and if price breaks this trend, then the second it breaks that, or it crosses over to the right-hand side of that trend line, you're out. You cash out for profit. Oh, really going? Right there. So you cash out here. You risk, and per trade, you should only risk 1% of your portfolio. So if you risk 1% of your portfolio, if you have, let's just say, I don't know, $50,000, that's $500 times, that was easily 10, that was a 10 to 1. In other words, the same space, this space, you could 1, 2, 3, let's count to like 10 times 500. That's not bad. That's pretty good. And you cash out for profit here, because by then you're already high. That's not where you want to be, buying. You want to be selling high. And it's also, the origin of this strong move. That's where weakness is. So it's green, but you get the point. It should be red. So perfect example, right? And I forgot to move it onto a daily. So then you would have bought low, sold high. Okay, and then we clear up all our lines, and that's all you do, right? And then again, at this point, you have another demand zone which it should be respecting. Sometimes like you get Pierce and it breaks. Actually, it's this whole zone, but you'd be more interested in cashing a bit earlier. And price just continues to go. So at this point, now it's really going. Price never came all the way back down into your demand or into your demand zone, and it is leaving without you. Let's kind of catch up to what that looks like on a 240. So yeah, at this point, you're seeing a massive rally. Don't freak out. That's exactly what you want to be seeing. Don't think that you've missed the train. The train's going to come back. You have ballistic movement 4 days of ballistic movement to the upside, that's 90 degrees on a 240, looks like this. That's unsustainable. It's not going to last long, and that's the last thing that you want to be buying after it's already made that move. You're not buying after it's showing you strength. You're buying into weakness. So it's actually the origin of this move is right here. The high and low of that day, let's just say that area. That's the origin of that ballistic move. On a 240, it would look like it would be this whole area. So you want to wait for price to give you a demand zone. That's excellent. Do not be enticed to to chase price. Within this large move, you have a beautiful ballistic movement out. So right here, this low, this area right here, and then rally base ballistic movement out. That's another demand zone right there. And then you just wait for price to come back down. 99% of your job is just waiting. You shouldn't be doing anything most of the time. Let's fast forward. So I want you guys to get bored. You'll get bored with me here. Let's make this smaller. Yeah, right there. Came right onto it. First touch right on the button. And then you want to buy low and sell high. So you bought low, you put a trend line on this thing, and you would have sold for profit right there. Let's get rid of these big lines. So you risk this, and then you cash out all the way up here. So that's another 10 to 1. 10% in about a week. When the S&P 500, I think for 2020, was giving you 17.5% a year, you're making 10% in a week. I'd much rather take the latter. And that's all you do. And to do that, most of your job just requires waiting. So that was platinum. Let's do two quick examples on. See, how long am I boring you for? 20 minutes. Okay, let's do this rather quickly. But you got the idea now. On right here, you're in a downtrend. You have a massive rally in price. You don't want to be buying that. You want to be waiting. And it took, including this rally, I think 9 weeks, because, excuse me, this is a weekly chart of the Swiss franc, so it works on currencies as well. Including this rally, that took 9 weeks for it to come back down into demand, which is right here. And from here to where you would have sold, and you would have put a trend line, and as soon as it breaks your trend line, right here, actually, hold on a second, we can, right there, from here, oh, wait, actually, I already got you there we go. Sorry, guys. From your demand zone to where you would have cashed out, let's say, right there, it broke your trend line. So it's 1, 2, 3, 4, 5, 6 times, and 6 and change. You risk 1% of your portfolio to make 6 in, I think, 9 weeks or something like that. And it required you to, be in a downtrend, break that downtrend, giving you a huge demand zone. You need to wait and not be tempted to buy that, then price coming back down, and then you can buy. And lastly, GameStop. A lot of people were really enticed on, remember it was really going, and then it went all the way up to 450, I think 500, and people were buying high. You don't want to do that. You want to wait, and it took waiting about 13th through, about a month. So wait 30 days for price to rally, and it's a pocket of air because it moved ballistically away from that. There's nothing sustaining that move. And then also to fall all the way back down through that pocket of air to the origin of the move, this rally base rally. And then you make, I think that's 11%, because you would have bought down here, put a trend line on. When it breaks the trend line right around here, that's 11 to 1. So that's what you should be doing. Waiting pays off. 99% of what you should be doing, whether you're trading stocks, futures, currencies, whatever, is not doing anything. Let price give you that demand zone if you're going long. Or let price give you that supply zone if you're going short. And to do that, it's going to need to move ballistically away from the area. Take time to do that. And take time to go back into those areas where then you can, hopefully if you're going long, buy, and if you're going short, or not hopefully, but if you're hopefully trading with the trend, you can buy low and then make a higher high and then continue going. And then if you're shorting, or if you're shorting a downtrend, then you can sell high and it'll break the most current swing low and make a lower low and maximizing your profit potential. So wait, guys. It's all it takes. It's not that difficult. It does take a little bit of patience and not getting enticed to take a shot you shouldn't be taking. So I hope this was helpful. I'll see you guys on the next one. Take it easy.